And I'm a very statistical investor. I'm someone who looks at the evidence, looks at the facts, and looks at the odds. And what I will say about the UK stock market is three things. It's cheap, uptrending, and rates are coming down. UK shares are significantly cheaper than their international peers. So the PE ratio of I did this today, the FTSE All share is about 14 on average on a median share. And Europe's more expensive, USA is way more expensive, and Australia is way more expensive. So you can look around and you can go, well, the UK is quite cheap. Now, many would say it's cheap for a reason, and they may have a point there. But in my experience, undervaluation tends to normalize through time. And when things are undervalued, they often start recovering. And I looked at the UK stock market and it's outperformed year to date. The FTSE All share is actually up about 9%. Europe and America and Australia have all underperformed. And there's quite a bit of evidence there might be some capital reallocation from America back to the UK. One other thing about undervaluation is it's attracting lots and lots of takeover bids. And when private equity is sort of, and corporate activities doing lots of takeover bids, things are cheap. And that's one of the reasons that the markets are moving. So, when smarter investors are investing, it's always a good time to be invested. The other thing is interest rates are falling. So this is the interest rate chart, and it's now falling to 4.25%. And I think Andrew Bailey was saying this week that he expects the path to be down. They'll never go down to this again, I don't think. But I want to sort of just say one thing that I learned a very long time ago, which is that you don't fight the tape and you don't fight the Fed. What that means in English is don't fight the market when it's going up and don't fight when interest rates are going down. So markets going up is positive. That's the tape. And the central bankers who control the interest rates, that's the Fed in America. And essentially, you don't want to fight any of these forces. And the forces are actually positive at the moment. So I am more bullish than I've been in years because I think the trend is positive. But I don't know what's going to happen in the market. So don't hold me to that. Who knows what will happen in the next 12 months. It's a very erratic world. What I do know is how not to pick shares. And I also know how to pick shares well. One thing to look at, I use these slides in a recent speech and a recent webinar as well, but I don't think most of you have seen them, so please indulge me. I put together this pyramid, which is called the 4 stages of investor, and they really kind of stack on each other. So I'm going to take you through this one by one. Firstly, everybody has an element of the gambler in them. I got investing in the stock market, was a total punter. And you often act fast and based on rumor, and you jump on bandwagons. And then when it doesn't all work out, you blame everyone else except yourself. That is a real problem. It's not the right way to pick shares. You can get lucky. You can do well in the short term. Feel free to join Wall Street bets and punt away. But what you tend to find is you get sort of pulled into story stocks. And what happens with story stocks, you find situations like this, which is currently one of the biggest story stocks on the UK stock market. It's called the Smarter Web Company. And this is what is called a Bitcoin treasury company. They're buying up lots of Bitcoin. And essentially they own, I think last time I looked was 50 million, but I spoke to somebody today who said they've now got 100 million in Bitcoin. But the market cap of this company is about 500 or 600 million. It's completely bonkers. And it seems like there's a huge sort of hype craze going on. And you see these sorts of stories, they happen again and again and again, and they normally end in tears. Unless you really are like the most ludicrous, your total Bitcoin to the moon bull. But stories are dangerous for private investors. And I see stories happen again and again and again. Because what happens with story stocks in every cycle, it could be Serious Minerals before 2020. I don't know if anyone got caught up in that. Avacta was like a huge pandemic darling, and it really shot up. But this chart's only from 2023, and it's been grinding down. Lots and lots of people talk about it a lot. They may cure cancer, love them too. We all have lost friends and family to cancer, and they've got a better way of actually delivering cancer treatments, and they're not necessarily cure cancer, but you see what I mean. But they need so much funding, these companies, and what happens is when they need funding, and these companies aren't profitable, they're always expensive, and they're always a bit hyped up. Story stocks are very difficult. Don't invest in shares based on narrative alone, because you find they need funding, and that dilutes you, and it's always bad. And I think recently, just after this end of this chart, they said no certainty funds will be raised. So you've got to be aware of story stocks. You've got to be aware of gambling. The stock market does not pay off for gamblers. The second stage is kind of the follower. And the follower is someone who goes, okay, this stock market thing, I want to take it more seriously. I'm going to find people who seem to know what they're talking about. and you end up following people. And we all follow people. I read lots of people. I also gamble. So you kind of like have all these parts of your psyche. And what happens if you're a follower is you're attracted to gurus, you trust an authority, but often because these people, whether it's the press, promoting big blue chip names, or it could be some PR, or it could be a broker, or it could be someone on Substack, it could be a writer you follow. Often they are better at saying, well, this one's undervalued, so you buy it, but they never tell you when to get out. And you can get very erratic results. You end up having regret cycles, and you don't have the full process yet. So you've got to be a bit careful there, because that's a sort of another kind of bias. And just to show you, this is Alex, who's actually on the call today. Alex Nomani reads great. He's got a great article on the site at the moment. But between 2014 and 2024, he did this fantastic study of the returns to broker buy recommendations and sell recommendations. And you can see here that strong buys did outperform strong sells in the return stakes, but they still underperformed the FTSE All Share on a 1-year holding period. So in other words, we've already seen on the chart earlier, the FTSE All Share really hasn't done much for 10 years. And strong buy recommendations didn't do any better than holds. And so again, this is kind of, when you follow people and you sort of outsource your research to others, you're not necessarily going to do as well as you could do on your own. So then when you start taking more responsibility, you become the researcher. And the researcher is somebody who obviously does deep research. I remember when I was a kind of global authority on a couple of shares, and I've told this story a few times, that in the global financial crisis, I ended up losing about half my portfolio because I was so convinced of my own rightness on certain shares. But you get really attached to your shares because you research them so hard, you build your spreadsheets, you gather all the information, and you can't let them go. And I see this again and again and again. And one of the real problems is over-attachment when you do too much research. And this chart is rather fabulous. It's from a very old study. Actually, it's about horse betting, but it talks about the principles. If you are given a certain number of items of information and you ask and you get the top 5, your accuracy may be at a certain level. But as you're given more and more items of information, as you do more and more research, you actually become on this red line more and more confident that you're right, but you don't become any more accurate in your prediction. And that is a real problem for stock market investors, because as soon as you bought a share, and if it starts going up and you live with it with a certain amount of time, you become more and more of an expert on it because you read every news story, you get to know the company, the management, And that means you can never, ever get rid of those shares. And trust me, all stocks are speculative. It is very rare that you find a share like a Games Workshop and hold it all the way and it keeps going up. Many shares go up for a certain period of time and then they come down again. And so being unattached is quite important. So be wary of the curse of knowledge. I have a few shares in my portfolio where I've done far too much research and I'm really attached to them. So anyway, the last level, I've only not got enough space to put it in. I call it the Craftsman. And the Craftsman is someone who has probably been through these phases and has elements of all of this, but you become more evidence-based, you become more process-driven, and you become more consistent in your results. And the returns I showed earlier of the model portfolio I run are all really kind of around this sort of principle of being more process-driven and more consistent. Even Charlie Munger, Warren Buffett's partner, said, no wise pilot flies without a checklist. So you really, even he uses a checklist. Even if it's in the mind, you always want to have a very consistent process. Now, that's kind of what I call the Craftsman. Now, I think there is a little poll here, which I might ask Sam if you could share it in the chat box. If you identify with any particular part of this pyramid, please do let me know. If anyone can share it from polls, it'd be good to get some feedback. And anyway, hopefully that will come out in a moment. But I'm going to crack on, because what the thing is, at the sort of the Craftsman level of this, I see that there is really a complete system of investing, and which is really kind of more involved than just selecting good stocks. Okay, it's more about there's really 3 elements of this, and I call it drivers, diversity, and discipline, 3D portfolio management.